In 2007, Warren Buffett wrote in his Berkshire Hathaway shareholder letter, "Since the days of the Wright brothers, the airline industry has never established a sustainable competitive advantage. If a far-sighted capitalist had been present at Kitty Hawk during the test flight and shot down Orville Wright, it would have been the greatest kindness to future investors." He wrote this in 2007. In 2024, his judgment remains correct. Airlines are not making money. This is not an occasional situation. From 1996 to 2022, the global airline industry almost never truly covered its cost of capital. This industry carries 4 billion people every year while systematically destroying investors' wealth. Then came 2024. 41% of airlines began covering their cost of capital. This is the highest proportion on record. Analysts started writing reports saying the airline industry is finally cracking the code of value creation. When you see this number, your first reaction might be, they have finally learned how to operate. This intuition is wrong. There is no revolutionary business model, no breakthrough technology, no genius CEO who reinvented the industry. All the structural problems are still there. Passengers are extremely price sensitive. Competitors can enter the market at any time, and regulation hinders true consolidation. Only one thing happened: a single number changed direction. Seat scarcity is not a feeling, it is a ratio. The total number of available seats in the world today divided by the number of people who want to fly today. Greater than 1, the industry is in oversupply. Ticket prices fall, losses occur. Less than 1, the industry is in scarcity. Ticket prices rise, profits follow. From 1996 to 2022, this ratio was almost always greater than 1. There were always too many seats chasing too few passengers. This is the physical reason why the industry continued to lose money, not management failure, but market structure that kept the ratio biased toward oversupply. From 2023 to 2024, the ratio fell below 1 on a systemic level for the first time. It is this one change in direction that caused everything you see in the financial reports. The reason is direct. In 2018, approximately 1,900 new aircraft were delivered each year, injecting new seat supply into the market. Then the pandemic came and factories stopped. By 2024, annual deliveries were still 30% lower than in 2018. For 6 years, the seats that should have entered the market did not arrive. Here is a correction that makes the numbers more precise than they appear on the surface. The pandemic did not just freeze supply, it also destroyed demand. After demand collapsed, airlines kept older planes that should have been retired in service. Under normal circumstances, 2.8% of the fleet is retired each year. Between 2019 and 2024, this number was only 1.8%. When demand recovered, there were fewer new planes than expected and more old planes than expected. The two effects partially offset each other. After correcting for delayed retirements, the real seat gap is approximately 9% of the global fleet. 9%, not a feeling, it is the extent to which the ratio fell below 1. This 9% is the source of all the good news in 2024. Before continuing, there is one capital markets fact that needs to be clearly stated. The market is not pricing the current seat ratio. The market is pricing the expected direction of change in the ratio. This means the most dangerous moment is often when the market is most optimistic. That is, when most people have just started to believe that the ratio will not deteriorate. Remember this sentence. It will be used later. If a seat ratio below 1 is the problem, why not just build more planes? The answer is that supply elasticity is extremely low. In most industries, when profits appear, capital flows in, capacity expands, supply increases, and profits fall back. This is the market's self-correction mechanism. The airline industry's supply does not follow this logic. It takes an average of 6 to 8 years for a new aircraft to go from order to delivery. Engine certification cycles take more than 10 years. Key component suppliers sometimes have only 1 or 2 players globally and cannot ramp up production quickly. Even when profits appear, capital cannot be converted into new seats in the short term. Supply's response to price signals is locked by a structural time lag of many years. The 9% gap will not disappear tomorrow, but it will eventually disappear. Now comes the most counterintuitive part of this story. Most people think that the collapse of the airline industry requires a sharp drop in demand, economic recession, passengers disappear, ticket prices collapse. This intuition is wrong. Demand does not need to fall, it only needs to stop. Then the system will collapse on its own. The mechanism is as follows. Factories are recovering, backlog orders are starting to be fulfilled, and new planes are arriving. New planes enter the market and old planes are retired in batches. But the number of retirements is always smaller than new deliveries. Net seat numbers begin to expand. The ratio flips from below 1 back to above 1. At this point, a feedback loop starts. Airlines prioritize protecting load factors and offer discounts. Yields decline, but costs are fixed. Leases are fixed. Personnel contracts are fixed. Maintenance contracts are fixed. Costs do not fall with revenue. Cash flow begins to come under pressure. To maintain cash flow, they cut prices further. Yields decline again. The loop tightens. When one airline cuts prices, everyone else must follow. In a world where the ratio is above 1, not cutting prices means handing passengers over to competitors. A small oversupply, amplified by competitive instinct and cash flow pressure, turns into a pricing collapse. This is not a physical collapse, it is a financial spiral. In 2019, global aviation demand did not decline, it merely slowed its growth rate, and the industry collectively lost $30 billion economically. It was not that demand collapsed, it was that pricing discipline collapsed under cash flow pressure. The last question, and the one that investment banks truly care about, is not who will win. It is, when the ratio reverses, whose asset mismatch is the most severe. Let's start with the highest mismatch. Airlines sign aircraft leases with average terms of 10 to 12 years. They locked in these costs at the peak of pricing power when the ratio was at its lowest. When the ratio flips, revenue becomes variable while costs remain fixed. This scissor effect is the direct reason airline balance sheets get crushed in every downturn. But the deeper problem is not the lease term. It is why airlines always sign the longest leases and place the most orders at the peak of the cycle. This is not because management is stupid. It is a systemic, cognitive, structural problem. When profits appear, when pricing power returns, when the financial reports look good, management experiences a sense of confirmation. This improvement has structural reasons. Under this confirmation bias, they expand. 3 to 5 years later, the results of these expansion decisions begin to deliver, and the market has already reversed. This mistake repeats in every boom period, not because there are no historical lessons, but because a decision-making system with a 2 to 3 year planning cycle cannot accurately perceive the market state 5 to 7 years later when the planes are delivered. The system structure makes correct decision-making almost impossible during boom periods. The biggest risk is not leverage. It is mistaking temporary phenomena for permanent ones at the peak of the cycle. In contrast, the link with the lowest mismatch is those who build their business models on time itself. Whether the seat ratio is above 1 or below 1, every hour an aircraft engine turns, its rotor blades are wearing down. Time does not change direction because of the seat ratio. Those who earn from ticket prices bear the fatal mismatch when the ratio reverses. Those who repair engines only charge physics and time. The airline industry will never become a good industry. When the factories recover, when the backlog orders are fulfilled, when the ratio flips back above 1, and when cash flow pressure triggers the financial spiral, those who believed in 2024 that they had finally cracked the code will discover that what they believed in was merely a temporary exception. Those who asked the right question will not ask whether this time is different. They will ask, when the ratio moves in any direction, can my assets still operate? This one question is the only important question that has mattered in this industry for the past 100 years.